All right, it looks like we are at time, so let's go ahead and get started. My name is Chin Chun, and I'm with NACBA and the Consultants Training Institute. Before we get started today, I wanted to go over a few housekeeping items. CPE is available for individuals who are subscribing to the international, around the Valuation World International webcast each month. There will be poll questions throughout the webcast. Please remember to respond to all poll questions to receive CPE credit. If you have any questions today during the webcast for the presenter, please use the Q&A option in the Zoom platform. If you have any questions, technical questions for me, please feel free to use the chat feature, as those will be directed towards me. CPE service will be available on nacba.com within 7 to 10 business days after the webcast. Yeah, and let's see, there we go. And oops, there are our technical editors. We have Wolfgang Nies, Andrew Newman, Pratik Shah, and Brian Jones. Today we have Wolfgang and Pratik joining us today. And with that, I'm going to turn the time over to Wolfgang. Give us some additional information.
Yeah, thank you, Chanda, and a warm welcome from Germany to all over the world. It's a nice audience today. Thank you for joining us. I would like to give some short notes on new information around the GACVA and the EACVA especially. There's a brand new magazine coming out this week. We, as EACVA, we publish together with the IVSC in London a new business valuation magazine for practitioners, from practitioners with 4 times a year. And this, the first edition, is now published. And if you would like to receive it for free, please go to www.eacva.com. and you will find a section with a download for the PDF file from this magazine. If you would like to receive the next issues by a newsletter, email, please let us know. So yeah, it's a great opportunity to communicate with you. And if you are also interested in writing articles, please let us know. We are looking for very broad perspectives on business valuation from the European perspective, but also from perspectives around the world. Next topic, our conference. If you are looking for a nice conference in winter, maybe you are interested in joining our conference in Vienna on November 3rd and 4th. Great place for a conference, and it's a 2-day conference with an English track with keynotes in English. And also, if you are interested in diving deeper into the content and look at the agenda under valuationconference.de. And the last topic from the EACVA charter is our international or English CVA training in November. If you are interested in getting more information on the CVA training in Frankfurt in November, please have a look and with eacva.com website. I think the next page, Chanda, is the 30 under 30.
Yeah, I just want to take a moment to let you know that the GACVA chapters are eligible to recognize individuals who are under 30 years old who are making impact in the industry. The deadline for nominations is this Friday. If you need a little bit later, just let me know. You can email me at chndac1@nacb.com. But yeah, we encourage you to click on that link and submit nominations for colleagues or anybody you may know who would qualify, who is under 30 and is a young industry maverick making impact in the field. So, right, and with that,
thank you, Chanda.
I'll turn it back over to you, Wolfgang.
Yeah, thanks let's turn to our topic today. It's a great pleasure to introduce Antonella Puca. She's CFA, CPA, ABV. She is managing director at MPI in Business Valuation Advisory in New York, and provides valuation service for investment managers, investment funds, portfolio companies. And as you might know, she is author of a book published in 2020, Early Stage Valuation, which is a very deep dive into these fascinating but also challenging topic. And today, so we have only 1 hour to give an overview, to dive into some of these aspects. And yeah, it's a great pleasure to have you here, Antonella, and I would pass the micro over to you.
Oh, thank you very much, Wolfgang and Pratik, for this introduction. It's a great pleasure to be here with you today, and welcome to everybody who is attending this webinar. So I am based in New York, as you can see. I mean, although this is obviously it's morning here, but still I like the night view of the city, it's a pleasure to have a chance to do this webinar. So I'm going to share my screen so that we can start going to our slides. Okay, so the topic of today's webinar is early stage valuation. Sorry, let me just move forward. As we will see, I mean, the early stage valuation is a broad definition that encompasses a range of companies that have two primary features in common. One is the fact that they are high growth, and the other is the fact that they're still not profitable. So you need these two features to be covered by the topic of today. So this is a brief agenda. We're going to give an overview of what it means to deal with an early stage enterprise. Also, we will talk about what we mean by pre-money and post-money valuation. These are terms that are very often found in the press when talking about the valuation of early stage enterprises. And then we're going to spend some time looking a little bit more in depth to a methodology that is can be very helpful in the valuation of early stage enterprises, particularly under US GAAP and IFRS, so for financial reporting, and also in general, this is a method that uses market inputs, as we will see, coming from the rounds that companies have to undergo in order to stay alive, because as we mentioned before, these are companies that don't generate enough cash to survive without having capital inflows on a regular basis. So starting from what do we mean by early stage enterprise? So key characteristics, I mean, here is a summary list. So we mentioned the fact that these are high growth companies. They have net operating losses and negative operating cash flows. Also, they may have substantial revenue, but still expenses exceed revenue. So some of the companies that we are that we know as unicorns fall under this definition. So you may have a company that is more than $1 billion in value, or 1 billion euros, but still has the feature that it's not generating income. It's still in the operating loss stage. And then often these are companies that have significant value in their intangible assets, and also that, I mean, a very important feature is that they have to turn to the venture capital markets on a regular basis to raise capital. So they're not self-sufficient financially. They typically are not in a position to be able to get capital from banks because they don't have real assets that are adequate for that. And venture capital investors are a key element for them in order to be able to survive. Also, early stage enterprises often have a complex capital structure that includes different types of stocks, warrants, options, and other instruments, as we will see in a moment. And also, finally, last features that they have typically high rate of failure, and often also this high rate of failure is accompanied by a high return potential. So in our discussion, we'll just for generally these companies are often divided into 3 stages. So stage 1 is what is called the seed stage or angel stage. So here the company still does not have revenue. We're talking here about the real startups. So there is little or no revenue, there is little expense history. And at this stage, financing comes primarily from friends and family. So in the form of small investments. And rounds are typically in the 200,000 to 3 million in range. So stage 2 is what we often refer to as early early venture capital stage, early VC stage. So in this stage, the company is starting to generate revenue, generally, at this stage, the company does have revenue to show, although it's still not profitable. And it is at this stage that venture capital investors, so professional investors outside the circle of angels and family and friends, start getting an interest into the company and are willing to provide initial financing. So at this stage, typically Series A and Series B rounds take place, as the company grows, it can reach quite a significant size, and it may even start raising the interest of strategic buyers or other types of buyers in an M&A transaction, in a buyout. So according to PitchBook, the median pre-money valuation for an early VC stage in June 2022 was $60 million. And then we move to stage 3. This is the later VC stage. So here we can find the unicorns that we were talking about. I mean, at the later VC stage, we have companies that have high revenue growth, may have substantial revenue, but are still generating losses. Marketing expenses may be significant, and they are raising capital past the Series B round, so they may be in Series C or above. And we're talking about companies that start having a pre-money valuation of 105 million or above. Also, these companies may contemplate an exit strategy through an IPO or an M&A exit, and we're getting close to a mature stage. So another important feature that we touched upon is the fact that all of these companies tend to have a complex capital structure. So in addition to the typical common stock, we also find preferred stock, warrants, options, as well as various types of hybrid instruments, particularly convertible notes. And most recently, with increasing frequency, I would say, a type of security that's called simple agreement for future equity, or SAFE. These are becoming very common in early stage enterprises. They've always been used, but I've personally seen an increasing interest for this type of instruments recently. So for ESG investments, key performance metrics are typically the internal rate of return. Basically, this is the rate at which investors get looking at the cash flows that come from these companies and the timing of the cash flows. Also, another important metric is the multiple of invested capital. So let's say that an investor makes an investment in a company of 200 million, and the company, there are distribution of 60 million. The investment value at the end of the period is 160. The MOIC in this case would be equal to 1.1x. So generally, you can look at multiples of invested capital at the fund level for investors in a venture capital fund, for instance. You can also look at it at the individual company level on an investment by investment base. Obviously, these are companies that generally don't distribute the cash. So in this case, the contribution would be the initial investment in the company. The distributions during the life of the fund of the investment would be zero, and the investment value would be whatever you think the company is worth at the end of the period that you're looking at. And that's how you would calculate your MOIC. And then the third variable is the time to exit. So the time to exit is very important because based on that, the IRR can change quite significantly. And in fact, this kind of gives you an idea of how important the time to exit is. So if you look at the box section, we're assuming here that, we have a polling question. I'm going to stop to give you a chance to answer. So, if you can take a moment to reply to the polling question.
Oh, Antonella, you can go ahead and continue with the presentation.
Okay, thank you. Thank you. So I'll go ahead. So here, this slide gives you a sense of how the multiple invested capital, the IRR, and the exit, the time to exit, work together. So if you have, for instance, an investment where you expect to exit at the 3x of your invested capital, your IRR is going to be very different whether your exit takes place after 6 years from your initial investment, 5, 4, or 3, as you see. So you may realize a 44% IRR if you exit after 3 years, but this IRR drops dramatically and becomes 20% if you exit in year 6. So that's something to keep in mind when you look at these investments. Now, so in terms of valuation approaches, this slides kind of give you a sense of what are the main issues and advantages and disadvantages of applying the various approaches to early stage enterprises. So we're looking at the standard income, market, and asset approach, and there are some lines. For the income approach, generally, this approach is not appropriate for stage 1 companies. Remember, stage 1 companies are companies that don't have revenue. So in order to be able to apply the income approach in some form, you need to have revenue projections, and you need to have the idea that at some point in the future, maybe not now, but a few years down the road, the company will become profitable, so that you start having positive net cash flows, free cash flows to the firm or to equity after a certain number of years. So even if the company is not currently cash flow positive, you can still apply the income approach, but you do have to have projections that are somewhat reliable, or that anyway, you can build with a reasonable basis. So one thing to say, we're not going to delve into the income approach in this presentation, but I want to say, one way to handle it for early stage enterprises is to basically divide the life of the company in various sections, stages. So you can start, with an initial stage where you have negative cash flows, and and then you can move to a stage of a high growth but declining growth, and finally you can have a stage of stable growth where the company essentially gets in line with the more mature companies in its industry. So this is one way that and you will use discount rates that reflect the changing risk of the company. So in terms of the market approach, the market approach is very often used for these companies because you can, as we will see, these are companies that have recent transactions in their own stock. So aside from the inputs that come from other companies in the market, which may or may not be reliable, you are going to have inputs that come from trades in the companies, or not even trades, that come from the issuance of new securities by the company itself. So that's where the market approach can be especially useful. And then the asset approach. The asset approach can be useful especially at the very beginning of the life of the company, stage one, when the company, they may not have revenue yet, but they may have invested in intangible assets, and you may want to consider the value of those intangibles in establishing the value of your company. So here is some selective valuation guidance. I want to emphasize particularly the ASCPA accounting valuation guide on the valuation of portfolio company investments of venture capital and private equity funds, which was released in 2019. This is a very comprehensive document that focuses on fair value for financial reporting, but it has a wealth of examples and a lot of ideas that can be applied, also outside the fair value context. It's a major piece of work, definitely something to look at, as well as guidance, from other organizations. So pre-money and post-money valuation. I wanted to spend a little time on these definitions because we hear them in the press a lot, and it's important to understand what we mean when we hear the company has X value on a pre-money or post-money basis. So post-money valuation is the valuation of a company after a new financing round has taken place. And typically, when we hear about a company having a post-money valuation of X, what is meant is that the valuation is calculated with the assumption that all shares of that company have equal value, and that all equity interests have been converted into common stock. So the calculation essentially takes the number of common shares on a fully diluted basis, multiply them by the unit price of the latest round, and gives you the value, the post-money value of the company. The pre-money value, on the other hand, reflects the valuation of the company before the new financing round has taken place, and it's equal to the post-money valuation less the invested capital from the latest round. Here are some examples. So here we have a pretty simple cap structure where we have 25 million shares of preferred of Series A, 3.5 million shares of common stock, and we have 100,000 options in the pre-money environment. And then we have a Series B round that adds 30 million new shares to the company, which are issued at $1 per share. So at the beginning, the company on a fully diluted basis had 28.6 million shares. And after the Series B round, it now has 58.6 million. So if you consider that the Series B preferred stock was issued at $1, so in order to calculate the post-money valuation, you just take 58.6 million shares and you multiply them by $1, and you get to your $58.6 million in value for the company on a post-money basis. And then if you want to get to the pre-money valuation, you take the 58.6 million and subtract the 30 million, and you get to the 28.6, which is the pre-money. So what is the problem with this? The problem with this is that in both cases, you are essentially ignoring the economic rights of the preferred stock. And you're assuming that all the shares have equal value. Now, especially in a case of an early stage company, that's typically not the case. I mean, investors do attribute a great deal of value, in fact, to the economic and non-economic rights of preferred stock, to the fact that perhaps, Series B may be more senior than the Series A, and both are more senior relative to common stock. So presumably the value of one share of Series B is higher than the value of one share of Series A, and that in turn is also higher than a share of common stock. That is ignored in the typical, post-money valuation approach. So that's something to keep in mind. And essentially, what you have when you listen to the to these values in the press is the idea that everything is value pari passu, and generally the valuation done in this way will be higher than the value resulting from a valuation approach that takes into account the liquidation preferences and the other economic rights of preferred stock. Now we get to our OPM backsolve method. So the method that we're going to talk about now is a method that instead is built on the idea that you need to consider the differences in the claims to the company distributions that are embedded in the various types of preferred and common, various types of shares that the company has. So this method gives great importance to the capital structure of the company and the different rights that each class and series of company shares has. So to give you an idea, here, we're going to illustrate the OPM backsolve method using a practical example. And we're going to look at a company that is issuing a new Series A preferred round. So the company has just raised 10 million shares of Series A at $1 a share and has 5 million common shares. And the rights of the Series A are senior relative to the common. Also, Series A shares are convertible into common shares. They are non-participating preferred, and there are no dividends. So the example that we will discuss refers to case study 10 in the ACPA PVC valuation guide. So this is the cap table of our sample company. So we have 10 million Series A preferred that are just been issued, as we said, and common stock of 5 million shares. So a total of 50 million shares. And now, what does the backsolve method do? Okay, the backsolve method is a methodology within the market approach that essentially derives the value of the company from the value of its own instruments, and particularly from the, in this particular case, from the transaction in the Series A shares that have just been issued. So Series A shares have been issued at $1 per share, and basically what this method does, it takes this $1 per share and says, given the cap structure of the company, and given the fact that preferred stock is worth $1 per share, the value of the entire company has to be Y. And then once that's defined, it allocates the value down through the waterfall to calculate the value of everything else in the cap structure of the company, including common, including options, so whatever the company has. So in order to do that, what we're calling, the backsolve method uses typically uses an option pricing model. So that estimate that is based on the idea that basically you identify a certain expected volatility for the company's equity overall, and then based on that volatility estimate, you assume that the company is going to generate a range of outcomes for from a potential sale at a certain time in the future, and then you allocate all those outcomes down the waterfall to come to your ending value for the company and for each individual class of shares. So an assumption behind this, the possibility of applying an option pricing model is that essentially for a company that has preferred and common stock, essentially the payoff to the common stock shareholders is equal to the owner of actually a set of call options on the company's value, some with a strike price that is equal to the liquidation preference of the preferred stock. So said like this, it seems complicated, but in fact, once you start applying this, you'll see it's not as difficult as it seems. So this gives you a sense of what the payoff of our company could be at various levels of exit values. So here, we have a situation that the top right of this slide shows you the payoff value of preferred stock at exit, and the bottom part shows you the payoff value of common stock. So let's assume for a moment that the company exit takes place at 5 million. So if you have 5 million at exit, all those 5 millions are going to go to cover the liquidation preference of our preferred stock. Remember that we had 10 million shares of preferred that were issued at $1 per share. So there is a liquidation preference for the preferred stock of 10 million. So up to 10 million in value, you see on the top right section, all the value generated by the company or from the enterprise value is going to go to the preferred stockholders. Then what happens is that there is a catch up. So the next 5 million in enterprise value. So if the company exit takes place at 15 million, what happens is that 10 million of that are going to go to the preferred, and then you're going to have the common stock that catches up until the common stock shareholders get $1 per share themselves. So you have the next 5 million that go to the common stock shareholders. And then moving forward, the company, assuming that the company the exit takes place at $25 million, anything above the 15 million is going to split pro rata between preferred and common stock. So that 10 million from 15 to 25 is going to be allocated to both the preferred and the common shareholders based on their pro rata share of the company's total equity. So that's at exit. Now, how do we translate this into our model with optionality? Because we are not looking at exit, we're looking at current value. So there are 5 inputs in our model. First, we and the model basically is built as a set of options that use the Black-Scholes model. So the inputs in our model are going to be essentially the same that are going to be driven by the inputs of the Black-Scholes. So what do we need to build our model? We need the volatility of the equity for the company. We need a set of exercise prices that we will discuss in a moment. We need an expectation as to when the exit from the company's investment is going to take place. Then we need the risk-free rate, which is typically based on the U.S. Treasury. We're talking about U.S. companies, but we need a risk-free rate. The point is with a matching term to our term of exit. And we need a dividend yield, which is 0, because we're dealing typically with companies that don't have dividends. So in an early stage companies, we can expect the dividend to be 0. So some of these inputs are pretty straightforward. The one where we need to spend a little bit more time is the exercise price. So what is the exercise price? And we're going to have a set of exercise prices which are given by the liquidation preference thresholds of the various types of series in the company stock. So in this case, it is a very simple structure. We're going to have 2 exercise prices, 2 breakpoints. One is the liquidation response to the liquidation preference of preferred, and up to that point, we know that all the value generated by the company is going to go to the Series A preferred shareholders. And then the second breakpoint is the point at which essentially will become convenient for the preferred shareholders to convert their stock into common, which is when also the common stock receives $1 per share. At that point, in order to participate in anything above $1 per share, it will be more convenient for shareholders to own common stock instead of preferred. So our second breakpoint is going to have this is going to correspond to the 15 million threshold. And now here is an example of how the model would look in practice. So if you look at the top section, okay, we have a line. Let's put aside for the underlying asset value of $13 3.8 million. That's what we want to find. So this is the result of our model. It's not an input. It shows on the first line, but it's actually the number that we're looking for, and we'll see how we can find it in a moment. The second line, the exercise price, that shows the breakpoints that we talked about before, which are essentially the points at which the allocation of the proceeds from that we receive in an exit from the company change. So in our case, we have two breakpoints, as we said. We have the 10 million, which is the liquidation preference of preferred stock, and then we have the 15 million, which is the point at which it becomes convenient for preferred stockholders to convert their shares into common. Then we have the rest are, all the rest are inputs from the Black-Scholes model. So we have the expected volatility. In this particular case, we have estimated it at 100%. I mean, this is generally based on guideline public companies. So we won't discuss it here, but you would estimate it based on that. Then we have the risk-free rate, which in this particular instance, we have estimated at 2%, and that's the risk-free rate that matches the expected term to exit, the time to exit, which in our case is 3 years. Generally, I would say, anywhere between 3 and 4 years is often a good default for early stage companies. This term has to be agreed upon with the management. It's important to get management's view for what the term could be. You have to consider that if you use terms that are significantly more or less than that, I mean, that can skew the valuation. So generally, my take on this from a practical standpoint is to, have a 3 years as a default in mind, and then adjust that depending on the particular situation of the company. So if the company is really expecting an exit earlier than that, that can be adjusted downward or upward depending on the circumstances. And then you have your dividend yield of 0, as we said. So the D1, ND1, D2, and D2, these are just formulas that come straight from the Black-Scholes-Merton model. And the value of the call option is, at the inception, when you're building the model, you can put just some kind of random number for the underlying asset value just to have something in there. Let's say you can put, 20 million, and you can, and the value of the call option is going to come from the Black-Scholes-Merton model. The incremental option value is just the difference between two consecutive value of call options. So is in the 4.3 million is the difference between 3.8 and 9.4. And then the breakpoint participation percentages, those indicate who is going to receive the incremental option value in the model. So that depends on the participation at the various breakpoint levels. So in our circumstance, 100% of the first breakpoint value is going to go to the preferred stock. 100% of the second breakpoint value is going to go to the common stock. And then after that, everything is going to be allocated pro rata, 66 and 33%, based on the fully diluted equity ownership of the two classes. And then, then the following section, the allocation of incremental option value, that just sums the value allocated on the various breakpoints to each class, and then. So in this particular case, we know, and that's where the backsolve idea comes into place. We know that the total allocated to Series A preferred stock has to be 10 million, because we know that the preferred stock was issued at $1 per share. So $1 multiplied 10 million shares issued is 10 million. So that's all that gets allocated to the Series A. So given that, what we can do is that we consider that number has to be 10 million, and then using the backsolve formula that we have in an Excel model, we can calculate what is the underlying asset value at the top of the model here that generates a result of $10 million for the Series A preferred and $1 per share for the Series A preferred. I mean, I hope this is, this is helpful. I know it's a lot, and please, if you have any questions, I'll be happy to, you can email me separately, and we can discuss the model some more. Okay, so there's a question: in an OPM backsolve framework, how would you deal with the situation without any exit date in place? Namely, the company tells you that there is no exit plan, no IPO, no trade sale, asset sale, liquidation, etc. How will you then calculate the values within the OPM? I think that the idea is the company may not have an exit in mind, but the investor might. So I think you would ask, depending on in which company, in which setting you are valuing it, you can estimate what would be a suitable exit, and you can also look at industry trends for similar companies. And you can also consider, so I would say these two features would be the primary ways to address this issue. And that's often the case, that the company tells you they don't have any exit plan, but how realistic is that? And the market can give you guidance of what actually happens to companies in a similar industry, in a similar situation. And there is also a comment: I believe the CPI is that the exit time could be a weighted average of potential exit times. That's certainly also a possibility. You have, at the end of the day, I mean, you have some discretion here. And that's part of where, your expertise as a valuation analyst comes into play. So one very important consideration is when you build, I mean, we've built a backsolve OPM model, but one important consideration is the reference transaction at fair value? I mean, basically, the soundness of our model relies upon the fact that the input that we're using, that $1 per share for the Series A preferred is a reasonable estimate of fair value. Otherwise, we wouldn't be able to rely on that transaction to build our model. So how do you determine that? I mean, you look at a number of factors. You can look at whether there are new investors involved, are the founders involved? I mean, is this an insider transaction, or are they actually selling shares to outside parties? So is there an element of compensation involved in the trade that you're looking for? So sometimes you may have transactions in common stock, for instance, that are at prices that involve that are done essentially by founders. So how much of that is really fair value, and how much of that is compensation of founders' performance? So that's something to keep in mind. I mean, you do need to have a reasonable confidence that you are really dealing with a fair value transaction to be able to use this methodology. So this is a follow-up to the previous slide. So this shows, now let's say that we are 1 year later. 1 year has passed from the initial transaction, and what can we do now to value, our preferred and common shares? So in this case, we can no longer. I mean, let's say that this company, the market has moved, and this company has perhaps performed above expectation or below expectation. We think that the value that of the transaction 1 year ago is no longer a suitable basis to build our valuation. So what do we do? In this case, we would typically estimate the value of the company using some other approach. So perhaps we can start from we can calculate the implied multiples of revenue that were associated with our initial transaction. So the 13.8 million, I think, that we saw before, let's say that the company had 1 million of revenue at that point. I mean, that would be a 13.8x of revenue. So and based on market trends and based on the new revenue of the company, we can calculate, what the new underlying asset value, the new enterprise value of the company is. So let's say now we conclude that based on the changing market trends and the company's performance, the company is now worth 22 million. So what we can do now is we can use the OPM model that we built before to allocate this value down to the various series and classes of shares to get to a new value for our Series A preferred and common stock. So now the 22 million becomes an input here. We have updated the volatility. The volatility is no longer 100%. There's been a decline in volatility in the guideline companies, and we now have it at 80%. The time to exit, now we are 1 year later, it's no longer 3 years, it's 2 years. So we update all these inputs, and we, based on a $22 million value, we now conclude that the Series A preferred is valued at $1.56 per share, and the company is 1.28. So that's how we can still use the OPM in this case. So one last comment on setting up the model is that the volatility that we use to build up the model is the equity volatility of the company as a whole. Now, if you think about it, I mean, the volatility of the company is really going to be an average, a weighted average of the volatility of each of its classes of shares. And we can expect the volatility of common stock to be quite different from that of a Series A or a Series C or a Series B. So typically, the more junior the class or series of share is, the higher the volatility. And this is important to think about when you are in a context where you want to apply a discount for lack of marketability, for instance. So that's not so common, I would say, in a fair value financial reporting environment under GAAP, but it may be common in valuation for tax purposes, for instance. So if you want to use a DLOM, you need to consider the volatility specific to each class of shares if you want to use, for instance, a put option model for estimating your DLOM. And you need to use at that point in your model the common stock volatility, not just the equity of the company overall. And that can give you some rather different results. Okay, so now we have covered the OPM. So we don't have a lot of time left, but I want to just walk through, just give you a sense. I mean, you will have the slide deck, so you can look at the slide deck for some details. But I wanted to show you how participate other times. So far, we've only talked about liquidation rights for preferred stock and conversion rights, of course, because the conversion rights determine how many shares of common you obtain by converting your preferred stock. So that affects the waterfall. And we have seen that in our example. But I want to talk also a little bit about the effect of participation and dividend rights in our structure. So here we in our slides present 4 scenarios. So scenario 1 presents the case of non-participating preferred where there are no dividends accrued on the preferred. Scenario 2, non-participating preferred with cumulative dividends at 8% per year. Scenario 3, participating preferred and no dividends. And scenario 4, participating preferred and dividends. So what are participation rights? Participation rights is the right to participate in the allocation of enterprise value without having to convert beyond the liquidation preference and without having to convert your preferred stock into common stock. So so basically what happens is that preferred stock first receives its liquidation preference and then starts participating pro rata in whatever else is allocated with the common stock on a pari passu basis with common stock shareholders. So if you remember before, we had the first everything was allocated to the preferred stockholders. Then everything was allocated to the common shareholders until they got to $1 per share, and then everything was pro rata. Now, if you have participation rights, the second step, so the part where everything goes to common shareholder is gone. So what happens is that once the preferred gets its liquidation preference, anything above that gets allocated to preferred and common shareholders straight away. Often participation rights are subject to a cap, and they are not all that common, as we will see. And then dividend rights. Dividend rights is these are rights of preferred stock to receive dividends, kind of almost as if it was a bond with interest. So instead of getting interest, obviously we're talking about equity. They're getting, this dividend rights, which is essentially they kind of add on to the liquidation preference of the preferred. So dividend rights are I mean, this gives you a sense of the average dividend percentage is this is data from June from PitchBook from June results of this year. The average dividend percentage is around 7%, and cumulative dividends as a percentage of total dividends. You can see in the slide. So I would say dividends are not very common also for ESCs, but something to watch for. In agreements when you see them. So the next slides, they give you an example of how to build basically the same OPM model that we had before, but in the presence of participation rights and dividend rights, and what the resulting allocation would be. So I'm not going to walk through each of these examples in detail. I think this is this first slide just shows the default case where there are no participation rights, no dividend rights. You have a company that has a $20 million estimated value, and you allocate it down. You end up with a $1.41 per share for the Series A preferred and $1.18 for the common. So this is the case of no participation rights with dividend rights, and you will see here the various cases. And the important thing is, I mean, you can. I think these are fairly straightforward to walk through also by yourself. Again, if you have questions, you can ask me. But I want to use this slide so that you can have some examples to refer to. The point is, at the end of the day, this is the summary of our results. So assuming a $20 million company and preferred and common stock, 10,000 shares of preferred, 10 million shares of preferred, and 5 million shares of common. These are the results from our model. And you can see that the results are quite different. So the bottom line is, participation rights and dividend rights can significantly affect value. And it's important to look at the agreements of the company to figure out if they are applicable. One caveat for dividend rights, you may find a reference to dividend rights in the agreement, but with the clause that they are at the discretion of the board. I mean, this means that basically there are, the board, unless they are declared by the board, there are no dividends. So you can ignore them in this case in the model. On the other hand, in some agreements, you will find that those are essentially mandatory. So in those cases, that's when you need to include them in your model. Okay, there is a question. Do you think that the OPM backstop is appropriate to use with participating preferred, or does it undervalue the common too much? So I think it's a useful tool to consider, possibly maybe not by itself, but as one of the scenarios. And there are also different ways to include the dividends. So you can estimate the dividends all the way up to your term of exit, so include them in the liquidation preference, for instance, for, let's say you have a term of 3 or 3 years. That will tend to undervalue the common stock. On the other hand, you can also take the position that you only consider dividends up to the valuation date. So their effect is going to be less impactful. So, again, I mean, this is an area where there is a margin of discretion. It's also something that you may want to, that the auditors may have a view in financial reporting. You want to make sure that obviously, you are aware of that. And also there is the question that sometimes you have provisions in the agreement that say that there are going to be dividends accruals that need to be accrued, but you know that the company is going to do a new round and is going to restructure the term of its agreement in a way that those dividends are never going to come to fruition. So if that's the case, you have to be realistic and figure out what's really going to happen to your company, not just what's in the paper of the contract. Another question, sorry. Okay, if the company has raised Series A 2 years back, but no subsequent round of investment, can you still use the Series A's 2 years back for setting for the valuation? So, I mean, 2 years is a long time. I would say, even 6 months can be a long time in a very choppy market, or in a market that's rapidly changing. But having said that, it really depends on what type of information you can get. I mean, if you can get nothing at all from the company, I mean, maybe you can get revenue projection, but the company has no financials. I mean, you're really in a hard spot, and all you have is the information for the round 2 years ago. I mean, there are still ways that you can use that round as a basis for calculating implied revenue multiples, and then update those revenue multiples, according to some information on company performance, maybe just revenue projections, and market changes all the way to the present. So it can still be useful. Having said that, I would say, once you get past 1 year, there is a question of whether other methodologies may be more helpful, just because, of the fact that round may not be as indicative of, current value, or even that implied multiples might be still relevant.
Antonella?
Yes.
There is an earlier question. How do you determine correct cash-on-cash multiples?
Sorry, how do you determine?
Cash-on-cash multiple. Cash-on-cash multiple?
In which, under which context? In the OPM, or I'm not sure.
Maybe Harry, you can give more details on this question. There's another question. What about convertible bonds with a cap? How do you convert that to a valuation?
Okay, convertible bonds with a cap. I mean, convertible bonds are a special situation. In a way, they are similar to the safes that we're going to discuss in a moment. Why don't we take a look at the safe? I mean, we have very little time left, and this is a complex question. So I want to cover this safe example in a moment, and then maybe we can touch base separately on this, and I'd be happy to address it, to discuss it. Okay. So for the safes, I mean, safes, just very briefly. Safes is a short term for simple agreements for future equity, so that these are contracts. These are not equity, they are not financial assets, they are investment contracts. They give the investor the right to participate in the next round of an equity offering of a company, typically at a discount from the issue price and subject to a valuation cap. So that's where the valuation cap also comes into place. They are similar to preferred equity in terms of cash out rights. And one advantage that they offer is that they allow an investor to participate in a future equity round without the need to fix the issue price immediately. On the other hand, one issue of these contracts is that they can stay as safes for a while. I mean, basically, they only come into place and really convert into equity once the round takes place. So if there is no round, they may never convert. I mean, that's not typically the case, but something to keep in mind. So here I have a very simple example. This is a safe that was issued with a valuation cap of 400 million at a discount rate of 67% from the future issue price. And the valuation cap is calculated using a post-money valuation of the company. So you have to assume that all the shares are going to convert into common, essentially, and you then including the convertible instruments, and then you count the number of shares, you multiply it by the expected round, and you get to your 400 million. So here are some terms. I mean, you can read them separately using the slides, but what I wanted to show you is this page. Here too, what I think is interesting is that we know that there is a safe round in this case that's executed of 12 million. So we have a $12 million safe round. The safe round is a valuation cap of 400 million. So this is an input. We know that the company before the safe round has 112 million shares. And we know that the discount rate is 67%. So these are our inputs: valuation cap, number of shares before the safe round, discount rate. What do we want? We want to know, we would like to use this new round of safe to estimate a new price that we can use as an input in our OPM model to estimate the equity value of the company. So the equity value of the company is not the 400 million. That's a cap. And also we know that this stock is, I mean, the safes are issued at 67%. I mean that there is a discount implied in the safe. So what is really the implied input price here that we need to find? So what we can do is that based on all this, we need to calculate the number of, essentially we need to calculate what is the conversion price that would, with a 67% discount, would generate, a $400 million value for the company. And at that point, what would be our discounted conversion price, which is 228. And for that, we can use a backsolve method using 400 million as our target and the conversion price as our, variable that we figure out with the backsolve. So once we have figured out the conversion price, then we apply the discount rate and we get to the discounted conversion price of 2.281, which is going to be our input in the OPM model. So you can use a similar approach, somewhat similar, for the convertible bonds. In fact, it's a little simpler, the model that you can use for convertibles, but the idea is the same. I mean, you do need to take into account the discount to estimate what the real price involved in that round is. And with that, I am going to stop. I think we have reached the hour after we passed it by 3 minutes. So thank you very much, Wolfgang.
Yeah, thank you, Antonella. Yes, thank you for this deep dive into some calculations. There is one remaining question. I think this could be interesting for the audience as well. One of the last questions. Sometimes I see the argumentation that applying a DLOM in an OPM result results in a double counting as investors in the financing round already consider for the non-marketability of the shares. What is your view on this?
Okay, my view on this is that there are ways to adjust the option pricing model to, instead of considering the volatility for, the volatility for the class of shares straight from your analysis, you can look at the differential volatility and the differential OPM. So there is a DLOM already implied in the round, and basically you only add the additional DLOM that derives from the fact that the volatility of your particular class of shares may be higher than that of the round that has taken place. So essentially use a differential DLOM. You don't use the full DLOM.
Okay, thank you. Maybe the last question came in very early this hour. Can you comment on the Crunchbase software? What about taking the average valuation of that particular industry from Crunchbase to establish a value? Do you have a view on Crunchbase?
I mean, not particularly. I think in general, I always think that you need to apply your judgment. I mean, it's hard to make an assessment on the software. I mean, the software is a tool. So in certain cases, the results of the software may be suitable. In other cases, you may need to approach it in a way that it reflects different perspectives appropriate to that particular company or valuation engagement. So that would be my suggestion. That would be my suggestion for any software. It's kind of, use softwares, but also consider it in the context of what you're doing and whether some adjustments are needed.
Yeah, thank you. Thank you, Antonella. Thanks to the audience, and sorry for the short delay. Our next around the Valuation World International will be, I think it's October 24th. The US version is on October 17th, so it's October 24th. And we will have Joseph Orlando as a speaker, and he will talk about valuation of wineries and craft beverages companies. So take care, and thanks again to Antonella, and see you next month. Bye.